Hey there, before we get started, just want to let you know today's Real Vision Daily Briefing is in partnership with the Gold Investment Letter, helping sophisticated investors successfully navigate capital markets and maximize profits in gold, silver, and mining stocks. GIL discovers the most undervalued companies and isolates special situations in the mining sector for their members, breaking down unique topics such as investor psychology, portfolio management, and macroeconomic trends, with a goal of drastically improving investment returns. Sign up for this free e-letter for immediate action. goldinvestmentletter.com. Should the market be more afraid of the Fed? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Cem Karsan, founder of Kai Volatility. Hi, Cem. How are you? Great to have you on with
Hey,
us.
good to be here. Always a
A-
pleasure.
And we were talking right before went on air with your heading into the weekend shirt. You're getting us there.
I
I feel
said,
like
come on,
Thursday is
weekend. Let's
appropriate.
go. No,
It's
absolutely. I'm
appropriate,
feeling festive
exactly.
today.
We love when everyone comes with their fantastic shirts. I'm sure we're going to get some comments. You're challenging Darius Dale in a shirt off, I think.
Oh, that's
Um,
Miami territory. I can't compete with that. This is Chicago.
I love it. Well, it's Chicago's best you rolled out in. So really curious to get your thoughts on the markets. We had stocks down, U.S. stocks down, bond yields also down, U.S. bond yields, VIX up a bit after hitting its lowest level in a year yesterday. I don't know what's top of mind for you as you look across these markets.
Yeah, so markets have been in a tug of war between fundamental kind of bigger flows, which have a distinct lag to them, right? An overhang that's kind of impending doom, call it, with structural short positioning, reflexively pushing back the other way, right? And this is a common story in recent history, right? In the last, call it 6 months or plus, really, um, and it's continuing. The difference here is that lag is starting to work itself through the economy, and I think that's the big part, right? There's $450 trillion of long assets in the world. There's about 50 trillion of domestic equities. Um, Most of that other 400 trillion operates on, or 350 trillion operates on a massive lag. Real estate, private equity, venture capital, even equity market demand operates on a lag. Because buybacks themselves, which have been at records in the first quarter, almost equivalent to last year's records, right, are starting to fall off a cliff. So I think that lag is coming. That 5% is working through the market. At the same time, the short interest and all of the short positioning is getting, going through a pain trade, and that
Mm.
is ultimately driving lower volatility. That push pull. Pair that with the Fed selling puts, giving deposit insurance back there at the bottom, and then coming up and trying to sell calls and talking, the market down with it. All of that is driving vol compression, but still march higher until this narrative changes and people get back on board. Usually these things die, take a long, slow death, or they have a dramatic squeeze before they roll over. That's what 99 was about. That's what '07 was about. That's even what Feb of 2020, before we knew about COVID, month and a half before the market rolled over. That's why markets do what they do at the end. So that's kind of what's top of mind, where we are, and
Yeah.
how things are moving through the
I
market.
think that's a really great thank you for that because it's a really great explanation of what seems to be things at odds with one another, and it just feeling like, something's got to give here. It's a great explanation for where we are. By the way, we're taking questions, everyone. So go ahead, and I know you've got them. So go ahead and put them in the chat, and we'll get to as many as we can. How do you think that it'll end this time? Because if it's either a slow, painful death that works its way out, or a more kind of spectacular, dramatic end.
Yeah, I
Does it
mean, the
what's
reality
it feel like?
is positioning, ultimately turns in one of two ways. And you need positioning not to be, if everybody thinks something's going to happen, it's not going to happen. That's just the way markets work. If people are positioned for it, that means there's a demand underneath the market counter that, right? As we saw last year. So you really need positioning to turn to match the secular, you need the narrative to turn against the secular realities. And that's generally what happens, to at least to an extent, before the end. And so That happens in two ways. One, it happens again with some type of blow off top, a squeeze in price, right? That changes narrative. That also changes positioning, structurally because people have to buy back, and also tends to unpin vol. So it can happen that way, which is my probably top guess of how this ends, or it can happen with time. Why does time matter? At some point, people give up. A certain amount of time just leads people to throw in the towel. And particularly as it relates to vol, people will not hold vol or convexity because there's a cost to it over time. And crowding happens. The more nothing happens for some time, crowding happens into short convexity because of it's very profitable as that happens. So historically, those are the two ways this resolves itself. Positioning versus secular structural flows can unpin from counter trend moves that are dramatic in fashion or time. And that's why things tend to take longer than you think or happen very counterintuitively with some type of dramatic blow off time.
Yeah. And when it takes longer than you think, then people start to think it's not happening. I mean, and
Correct.
we've had people asking, and in fact, a viewer just asked yesterday, what happened to the Fed rate hikes? Like, where is the impact on the economy? Why haven't we seen that yet?
Yeah, so that part is a lag. That's another reason things take longer. People see the headlines and they think, oh, it's already started. And again, and buybacks would be that perfect example, right? Like we started a year ago, going from 0 to 5% in rates, right? And yet buybacks are still at a record. Real estate, last housing starts showed a 22% increase in single family home housing or multifamily homes housing starts. That's not because, that doesn't make sense given that interest rates have gone from 0 to 5. Why? Because all the projects were started a year ago. And so this lag takes time to work itself through markets. People assume it's instantaneous. QE and QT are fairly instantaneous. That's different, but we haven't really had any QT, right? But the interest rate piece working through the economy is very much a huge lag that people underappreciate.
So when we're looking at, so we had economic data, and you are starting to see some weakness, but it feels like every time we get a sort of steady drumbeat, we had Philly Fed survey was weaker than expected, weekly jobless claims were up, but every time you get that, you also see signs of strength someplace. So it still looks like it is working its way through the system. We've got a lot of Fed speakers right before we go into blackout. In fact, someone asking why so many Fed speakers. But Loretta Mester, out Cleveland Fed president, speaking today, once again signaling she supports higher rates, although putting a caveat on there that there should be prudence around it. What are you expecting from this May meeting from the Fed?
So before we get into the exact what to expect from the Fed, let's talk about the why. You can't look at this 5% increase in a vacuum. Why are they increasing by 5%? Let's not forget we did $9 trillion of fiscal stimulus in a year and a half. That's more by an order of magnitude than anything we've ever done in real terms. That is still in the economy. That is still coming, flowing through the economy. On top of that, we had lockdowns. China just exited lockdowns like a quarter ago. They're just now re-stimulating. You have throughout that period a strong dollar, which is very disinflationary as well. So we've had actually massive disinflationary forces in the context of a very inflationary push and fiscal stimulus. That is now those other items, like we've had dollar weakness, right? Now we have China coming back online. All under the context of that fiscal stimulus still working through the economy. So there is a demand push here that people are underestimating. There is a underlying strength to demand that is underappreciated. So yes, we've taken 0 to 5, and that is lagging through the economy. That is a lot, by the way. 5% change in a year is a ton. And that's still working its way through and counteracting this. So why haven't we seen it? Because there are countervailing forces. And that is what's going to force the Fed's hand to continue, in my opinion, to continue to increase and talk down this market. They need a lower market as well. They need a negative wealth effect. They need a stronger dollar, right? They need several things that are kind of fighting against them. Never mind OPEC stepping back into the fray and underpinning oil prices, which for a while there were still relatively calm for the last year after that initial push. So I think it's very important to note that if you look back a month and a half ago, the Fed was trying to take interest rates higher. Before this little banking crisis, they were trying to talk down the market. They were trying to strengthen the dollar. They're trying to do all these things. Um, and then what happened? Interest rates went lower, oil went higher, the dollar got weaker. I think if you think the Fed's going to come in here and pivot, you're talking yourself into a trade that doesn't exist. The Fed has been pretty clear the last several weeks, and honestly, the last several months about where they stand on this. So I think the Fed will continue to sell calls, and I think just like last time, the markets aren't listening because positioning is already again reflexively betting on that, and the pain trade is higher. But that doesn't change the secular realities of what the Fed is doing.
That's so interesting. By the way, when you're talking about the amount of stimulus that went into the economy, I've got to dig it up. I don't have it at my fingertips, but I know that we put it up in my interview with Nancy Davis. Well, I'll try to find it and tweet it out. That it's if you look at a chart at what was happening, even with QE, what happened during the pandemic was just off the charts. I mean, it's a huge injection into the economy. So your point about having to work that through is an
And
excellent one.
and
When
it's
you
not
see it
over.
visually,
We
it's
keep
stunning.
we keep getting more, by the way. It's not
Yeah.
over. And my prediction is the worst thing that can happen in this market is actually that we get a recession, which I don't think a deep recession, which I don't think we're going to get. But that would be the worst case for this market because guess what? Next year is the beginning of an election cycle, and you better believe if the economy is not great, expect another $2 to $4 trillion. And again, people can't believe it. People have been like, "Oh, they're not going to do more." They said that at 6 trillion. They said that at 7 trillion and 9 trillion. The reality is, it's popular, and no matter what you think about the economics, it is what the increasing, the millennial generation on down wants, and those are the votes that people are battling for as they become a bigger and bigger part of the election story.
Yeah. Ignore the nonsense around the debt ceiling. They're all going to spend it. That's what they've done on both sides
Give me incentives, I'll tell you the outcome. It's pretty
Yeah,
straightforward.
exactly. I a couple good comments that I want to bring up based off of what you just said. But since we're talking about the difficulty of the Fed and inflation, I just want to run a clip from my colleague Andreas. Just released his latest steno signals, where he's kind of focusing globally as well on what's happening with China and the China reopening as it relates to inflation. Let's listen to a clip of that, and then we'll talk on the other side.
So I'll show you a chart on why I think there will be a huge building boom in China relative to the last couple of years. The dark blue chart is the yearly change in the price of credit in China. So when the dark blue goes up, it means that credit is more easily available, both from a price perspective, but also from an availability perspective from banks. And we've seen a sharp rebound in the dark blue line, meaning that the credit is now available to an extent not seen in a few years. And the light blue is the index of newly started housing construction in China. So it's been completely under the weather for a couple of years due to this credit contraction, due to this Lehman-like event in the Chinese economy. But now, looking into the second half of the year, I am starting to convince myself that the rebound in the construction activity will resemble the rebound seen after, for example, 2008, 2009, and after the 2011-2012 debt crisis in Europe. So it will be, from like a sequential perspective, a very severe move from a contraction to an expansion, which is typically something that spills over to asset prices of relevance to this story. And industrial metals are obviously linked to the construction activity in China, China being the biggest consumer of copper, nickel, tin, stuff like that on Earth, meaning that the Chinese cycle is the most relevant cycle to these industrial metals. It also means that inflation could resurface in Europe and in the US with a time lag to this construction boom in China, if I'm right.
And you can see that full interview on the platform. It was just released today. Andreas coming to us live from Singapore. I love it. So no wonder he's thinking about what's happening in Asia. If you're not already a member, you can hit the QR code or the link in the chat. Jem, presumably, if we've got that working, in addition to everything else we just talked about, I mean, this is a more serious inflation problem for the Fed.
Yeah, I mean, look, we kind of mentioned this before, but there were a lot of things going for us when inflation was hot and the Fed started fighting it. Again, China lockdowns, a strong dollar, oil prices being kind of held down by the reserve kind of releases during the last election, and again, all those things now are going the other way. All of them. The dollar is weakened. You're seeing a strength for demand out of China, coming out of lockdowns, and oil prices are now being held up by OPEC, and they're cutting supply. So I would add this to the pile of things that are going to make structural inflation, are going to make it sticky. It has been sticky for some time. It's going to continue to be the case. I really think people are underestimating. I think the biggest thing here to realize is everybody is still trying to play some cyclical inflation game, that if we go into some recession, that inflation is suddenly going to be vanquished and we are going to move out of this. We're going to let's play the direction of bonds based on the cyclical turn in demand in the short term. I think it's so important to look at the structural realities of populism, of deglobalization, of all of resource scarcity and conflict that we're seeing globally. That is what will underpin inflation. Is what underpin inflation in the 60s and 70s. We are seeing exactly the same dynamics play out, and that is not a coincidence. That is what happens when you reach a point in a cycle where a generational belief that things are unfair, that they need to be created to be more equal happens. That's where we are politically. This is somewhat of an inevitability. People want this that are younger. They believe things are unfair. They can't afford housing. They can't afford things. And so we're going to give them money to do it, which is ultimately inflationary.
That populism aspect is such an interesting one. And it's something I think we're going to be talking about a lot more over the course of the summer. So even if you believe all of that, though, what about the issue of financial stability? I mean, can the Fed, even if they want to, fight inflation without destabilizing the financial system?
They can. To be clear, they can raise rates while still underpinning the tail. That's what they just did, right? They just went and secured deposits across banks, and then they are going to keep raising interest rates. Everybody plays a very linear model where they're just adding all liquidity together and saying, well, what's net liquidity and what does that mean? That's not how the world works. So we try and talk about this with options all the time. It's not just a matter of up or down. There's a difference between buying deltas or buying the market by selling out of the money puts or buying stock. They're not the same thing. Liquidity is the same way. If you underpin the market by securing depositors, that is not the same thing as going and buying stocks or buying bonds. It is not just simple QE. Those are different things. So the Fed has underpinned the left tail, the deep left tail, but they are still here to bring down demand in the market. And those things have very different structural effects and operate in different dimensions of the distribution. I think that's so critical to understand. They can do both, and they are attempting to do both. That is part of why vol is dampened like it has. They are both selling calls and selling puts on this market.
I love it. This is why it's so important to catch up with folks like you, because I think someone described it as if you can sort of understand what's going on in options, it gives you more of a 3D view of what's happening as opposed to looking at it in a linear fashion. And I think that you're right. That's so important. We've got some questions that I want to get to from some of our viewers and some observations. I love this comment from Francisco. If markets need to squeeze shorts out and make people lose conviction by painfully trading higher, wouldn't the same logic inversely apply to the buy the dip mentality cemented over the last decade? This is the question. What will it take for participants to lose conviction in passive investing?
I think that's actually a great question. I think time, as I mentioned, right, will play a huge role in that. Ultimately, there was no passive investing in 1982, not because it was a technology that didn't exist. It was a technology it was a thing that didn't work for 20, 30 years prior, right? 68 to 82 markets went nowhere in nominal terms and lost, 70% of their value in real terms. So nobody passively traded, never didn't passively buy the market. I think with time, people will begin to realize, my wealth advisor is not making me money. I'm paying them money for just buying me beta, and beta's not working. So much like there are very few active managers left, right? Because everything went into passive. I think there will be a decade plus move back to people who create value. It's more expensive, it's more fee heavy, but that's what you have to do in order to create real value, as opposed to just buy assets. So I think it'll take time. I think that's the biggest component. The other one is pain to the downside, right? So at some point, people will not lose conviction until they start feeling that pain. It's almost always a function of price and time.
Yeah, when you were talking about the Fed taking demand out, does that mean that they also need to see the stock market lower? Is that part of the plan?
Yeah, a wealth effect is definitely part of the solution in their minds. I don't think it's their primary vehicle, goal or way of affecting this, but they definitely don't want speculation. Speculation tends to also come from the populace, and you don't want people making $1 gazillion on Bitcoin and tech names, YOLOing tech names. You really you want institutions to do okay. That's fine. But ultimately, that you don't want that inflationary wealth effect, and that's true for real estate as well. So there's a broad need to take some of the air out of what's going through the market.
Kevin asking, please ask Cem, has he noticed an impactful increase in participants selling calls, buying puts to hedge against long positions? Also, has there been demand for margin puts? What's the impact of these flows?
Yeah, so have not seen much put demand. For a second there, we in the banking kind of the throes of that 1 week banking crisis, there was a bit of a spike and skew relative to where it had been. It is still elevated relative to where it was maybe a month ago, but still historically very, very low. Demand is quite low for hedging. Two structural dynamics have happened in the last 6 months that I think are very important positioning-wise. One, the move has been from Vega, so month plus out options, right, used for hedging, to more very short-dated 0 DTE. You've heard about this phenomena quite a bit. Short-dated gamma-intensive options for hedging, because Vega has not performed and has been a source of losses within portfolios in a dramatic way. So people have moved to 0 DTE. They are very gamma-intensive positions, but what that generally leads to, people assume that they can catch the realized move if they keep buying them. But and they won't need the Vega. The problem is what happens sometimes is the market won't move for some time, yet Vega will start to work its way higher. So the insurance costs can start to work their way higher on the long end of the curve, and short-dated options won't hedge in that environment. That usually happens before a decline. We saw that in 2007 in dramatic fashion. Again, we saw that in 99 in dramatic fashion. And my bet is here now that people are no longer hedging with Vega and looking for gamma, that you'll likely get Vega implied volatility going higher, despite not being in the throes of a decline before a decline comes. So I think based on positioning, that seems what's likely. Separately, we've seen a dramatic amount of hedging on duration for some time. The NASDAQ in particular and tech names, that has now, as of last OPEX, right? As we went into that OPEX, we saw a dramatic reversal in activity in the market as a function of that. That positioning was overhedged tech, underhedged kind of value in other broad sectors. My guess is as vol goes higher, usually correlation goes to 1, and so we'll likely see an underperformance in value in small cap in areas of the market which have not been as well hedged, and likely see correlation broadly go to 1. Even S&P vol begin to perform for the first time in years.
So if anyone out there is feeling a little bit lost, because that was a little bit technical, the question was, as was the answers. I'm just going to remind you that we have an entire section on options on the Academy on our website. It's important stuff. But I heard you just say at the end, for people who may not be that familiar with this, since we have a wide range in the audience, it sounds like you're saying value is going to underperform. Is that what you're saying, or it's going to come out of its underperformance?
Yes, I do believe in the short term into the next decline, when it does come initially, you will have a counterintuitive move of duration, particularly large cap tech, outperforming. Now that's outperforming into a decline. That doesn't mean it's going to rally, to be clear. I think small cap value in particular, Russell puts, for example, are a place of potential significant weakness. I would even think that places that are crowded, like the commodity sector, could be at risk into a decline simply because of how positioning is looking in the market. Again, as markets decline and implied volatility rises, correlation naturally tends to go to 1, and things with a higher beta tend to outperform actually relative to lower beta things. And again, the positioning dictates that that's probably likely to be the case as well. That said, my secular view still holds that value is a secular outperform for structural reasons, that duration is a secular underperform, that commodities will outperform. But it doesn't mean that pain trade won't play out first before that ultimate buying opportunity plays out.
Yeah, and this is why we talk about time horizon when we mention these things, because there's this shorter term dynamic that you're talking about before your sort of longer term, more secular thesis. TC asking, any comments on the June VIX call action yesterday?
Yeah, so there's been a lot of under the hood, interesting trades, structural, bigger trades, both S&P, VIX calls, et cetera. They have, I think they tend to have a fingerprint of a few entities that are fairly recognizable as entities that tend to be smart money. So I would there hasn't been a massive amount of volume, but I will say who's buying is interesting right now. Again, I don't think that necessarily means that we are going to get an impending implosion in the markets. But I do think it does speak to how vol is reaching a nadir. And that entities who kind of get it realize that at least from a vol perspective, maybe not as much a directional equity perspective, things are likely becoming interesting in the sense that we're getting towards the last innings.
Joseph asking, so where do you put fresh money, if anywhere? The $1 million question.
Well, I think the implicit what that implies is that putting money to work means buying stocks, and I think that assumption itself is flawed. I think again, I'd like to reiterate the last 30 years, 40 years of equity outperformance and multiple expansion has been a function of decreasing interest rates. And if we go under the secular assumption of interest rates are secularly going higher, which I don't think is is necessarily the case, but is definitely highly more probable than it has been. You're dealing with a period of particularly price to sales, which is what matters, massive overvaluation, and looking for a likely period of multiple contraction in the context of that. So my point is, if we are in 68 to 82, which I believe as a metaphor, we are likely heading into equities are one of the last things you want to buy. That said, there are things you can invest in, and I think that's different. People confuse investment as being something that you have to buy an asset, and that's not necessarily the case. There are lots of ways to invest very profitably in periods like this. There are more dislocations under regime change. There are more relative value opportunities during times of shifts in the market. There's more risk premia during times like this because liquidity is coming off the table. So there are significant opportunities, as we've seen in the last year, to profit if you have knowledge, if you have an understanding of how markets work. The problem is your average person, everybody thinks they're an investor. Everybody thinks they know how to manage stocks themselves. Expertise matters at the end of the day. And if you can find that expertise or have that expertise, it's an incredible time to be an investor.
Yeah, that's the hard part, isn't it? As scary as this period of change or regime change is, that's what we're hearing. There's opportunity, but figuring out what the real opportunity is, as opposed to the red herrings, I think is harder for folks maybe who are earlier on the learning journey. Erin asking, in case of a blow off top, do you have any opinion how it will play, short period or long, and does that indicate the depth of what follows?
Yeah, I would say it's kind of like stretching a rubber band. The faster it happens, there's kind of three reasons why, this ultimately plays out the way it does. You unpin volatility the higher you go because you slide to lower implied volatilities. Calls have a lower implied volatility. So as the market goes up, vol gets low enough where it encourages investors who to come buy vol and raise implied volatilities and make vol less supplied to dealers and structurally to the market. I know that's a technical thing, but I think it's important to understand that dynamic is very important to kind of the unpinning of markets into to the upside. B, you squeeze out shorts who are trying to short the market. The narrative changes. You ultimately get people getting pushed back in because they believe things are turning. That psychological component is very important. But lastly, the first order effects of simply something being pulled, potential energy of being pulled higher and higher off the floor is like, releasing a rubber band when it does come. So there's a reason that markets play out the way they do. And the faster that happens, the more powerful it can be and the more volatile and unpinning can happen. So yes, timing does matter. The speed of that happens matters. But again, time will itself cause this positioning to change. And so you can get a situation with over time, this happening more slowly and then eventually positioning being more balanced. But again, the secular realities still stand. And I think that's the important piece to keep in mind. It will take conviction in the face of counter trend moves by definition to profit from these. And generally, you don't want to be early. You want to be looking for those final turns and positioning before you play the secular realities of what's likely.
We just all learned so much and we're already out of time. I feel like we just scratched the surface, but there's some really, really important wisdom and points in there, Cem. So we so appreciate you sharing them all with us.
Always a pleasure to be here.
We have
Happy to
the
come on
crowd
whenever.
clamoring to get you back for an extended, and I absolutely we will make that happen. So we can dig in a little bit more with some more time and answer some of the questions we didn't get to, but we appreciate you today.
It's always a wonderful conversation. Thanks for having me.
Thanks so much. And thanks to all of you for the great questions. We'll work on a date with Cem. In the meantime, we will be back tomorrow. Ash is going to be here with Harry Melandri, so be sure to join us for that. In the meantime, take care and good luck out there.
Just a reminder, the Real Vision Daily Briefing is in partnership with the Gold Investment Letter, helping sophisticated investors successfully navigate capital markets and maximize profits in gold, silver, and mining stocks. GIL discovers the most undervalued companies and isolates special situations in the mining sector for their members, breaking down unique topics such as investor psychology, portfolio management, and macroeconomic trends, with a goal of drastically improving investment returns. Sign up for this free e-letter for immediate action. goldinvestmentletter.com.